Hello everybody, and welcome to this webinar which is looking at the Black Scholes Option Model, specifically the Black Scholes Option Model as it applies for the valuation of shares or stock in private companies. This is a webinar delivered by the International Institute of Business Valuers. I'm a director of the iiBV and I'm the chair of its education committee. And the iiBV provides training in North America, Europe and other parts of the world in various aspects of business valuation. Now, one thing I will say is, as we all recognise, all of us who do business valuation work, is that there is a constant requirement upon us to make sure we keep up to date and to do continuing professional development. And I hope that you find this a very useful webinar in respect of that. Now, the Black Scholes Option Model was devised by three people in the 1970s, primarily by Fisher Black and Merrin Scholes. And the idea of the Black Scholes Option Model was for pricing options in the public markets. And once the model was devised in both Chicago, New York, London and other places where there were very liquid stock exchanges, then options trading exploded as there was now a way of coming up with some scientific pricing of those options. And the interesting thing is that the option model can be used by some lateral thinking for the valuation of shares in private companies. Now, the model has the rigour and the strength of a mathematical proof. There is a need for certain simplifying assumptions to be accepted. Once those assumptions are accepted, we are then dealing with something which has got all of the rigour of a proof in math. Now, although it's devised primarily for valuing call and put options in the public markets, it can be used for the value of early stage companies. It can also be used for the valuation of different types of stock. If one has 2 or 3 different types of stock in a company, then the Black Scholes Option Model can be very effective in valuing those various types of stock. And it's especially relevant if there are certain stock which have got hurdles in respect of the value at which they start to kick in. Now, we'll put up the formula on the screen. I hope you can see this. That's the summary formula, and we'll be looking at that formula and explaining where some of those figures come from. It looks deceptively simple, and I say you mustn't relax too much at this point, because on the next slide we're going to show you what D1 and D2 are, because you see there we've got S times N D1 minus N D2, and here we have the formulae for D1 and D2. Now, one has to say that those look like a couple of car crashes or some horror movies. In fact, what we can do is don't recoil from them, don't be frightened or put off by those two formulae. We'll be looking at D2 in some detail, and we'll be seeing how we can derive D2, and we'll then look at D1 in overview. So although they initially look rather intimidating, do not be put off, because we can explain them in a number of simple steps. Now, what both D1 and D2 are, they're Z-scores, and I'm using the North American term Z rather than the European term Z. It's the same letter. I recognise that we are two countries divided by a common language. I will be using Z throughout, and I hope people on this side of the water will recognise I'm referring to the letter Z. Now, because they are Z-scores essentially are saying how many standard deviations away from the mean a particular item in the population is, and therefore most of the values will be between minus 1.5 and plus 1.5, and nearly all of the values will be between minus 3 and plus 3. Because that is the nature of a normal distribution and Z-scores within that. Now, what we'll do is we'll now look at the pricing of some options in the public markets. So if we look at the first line there, we've got a stock which has got a current price of $10, and someone takes a call option, in other words an option, not an obligation but an option to buy that stock sometime in the future, and we're looking at a 2-year option, and so they're going to they have the opportunity to buy that stock in the future, but at a value which is higher than the current value. The value they can buy it at is $12. So although the current stock price is $10 and they have the strike price, as it's called, in other words the price at which they can exercise the option is $12, despite that fact that call option costs money, and you see there that the cost of that option is $1.16. So if we then look at the third one on the example, you can see where we've got the stock still has a value of $10 and there's a strike price of $10, and what we then have, you then see that the cost of that option is $1.87. Now we'll linger on this slide for a little bit, because what we can now do is if we add a few noughts onto those numbers, we can therefore say if we have a company which has got a value of $10 million, then we have a means of valuing how much the bit above $12 million is worth. Now that sounds a very strange, counterintuitive comment to make. The idea that if something is worth $10 million, that there is value above $12 million. But that is precisely what the markets are telling us in respect of call options. And so if we take that first example, we can say, does that therefore mean that the value above $12 million in that company, which has a current value of $10 million, is $1.16 million? And we can then look at it again and say, okay, and that therefore means by extension, if we take the third line there and look at the $10 line, if the company is worth $10 million and we have a strike price of $10 million, then we've got a value there of 187, and that therefore means that what we can do by implication is say that that layer between $10 million and $12 million is worth the difference between 1.87 million and 1.16 million, and that's $710,000. So that's the innate, that is the kernel, that is the nub of what we're going to be looking at this morning when we're coming to applying Black Scholes to private companies. The idea is that although that private company has got a current value which is not disputed of, let us say, $10 million, despite that there is value in the stock of that company above $12 million at the present time, and that value can be derived from the public markets. And we all recognise that in the business valuation world, or the Anglo-Saxon business valuation world, I should be saying, that market evidence is everything. Everything but everything is based upon market evidence. And so we have strong market evidence here for valuing something which is worth more than the current value. Now, there are 6 inputs into the model. The first input is the risk-free rate, and the risk-free rate is what you get on treasury bills, or in the UK it's UK government gilts. We then got the volatility of the stock, and the volatility of the stock is essentially how far it deviates from its standard path, and we'll be looking in some detail at how we compute volatility, what volatility is, and means of addressing volatility when we consider the stock of a private company, because volatility is essentially a public market concept where shares and stocks are being traded on a daily basis. Then the third one is the length of the option period. The Black Scholes Option Model applies to what are called European options, which can be exercised at the end of a period, and therefore there is a need to determine the period. The 2 critical inputs out of the 6 that we're looking at here are the volatility and the length of the period. Those are the 2 critical inputs. The risk-free rate is known, it's not judgmental, it's the risk-free rate for the length of the option, and so that's fairly factual. And the current stock price and the strike price are normally things which one can determine fairly easily. So it's very much those 2, the volatility and also the length of the period of the option, that are the critical inputs in the work that we're going to be doing. The final point is the dividend yield. I'm not going to be addressing the dividend yield today. Suffice it to say that the original Black Scholes option model looked at did not include a dividend yield. It came up with a model assuming there were no dividends. To actually add in the assumption there are dividends is not difficult. It just extends the formula a little bit, and so it doesn't add any major additional complexity to things. So if we go through the structure of this session, what we're going to be doing is this is the first part of a 2-session webinar, and so I'll just take us through some of the issues that we're going to be addressing. The first thing we're going to be looking at is actually some of the terms, some of the language of options. We all know that language can be used as a way of keeping out the uninitiated. So there is some complex language. We can go through that language, explain what the various terms mean. We'll then look at the underlying simplifying assumptions which had to be made in order to make the world a simpler place so that the mathematical model would then work. And we'll then look at some of the intellectual heritage, the information which Messrs. Black and Scholes actually were building their model upon. And we'll then look at the skeleton of the Black Scholes Option Model, so we can see where the main components of it comes from. And in order to do that, we'll be looking at the exponential number E. Now, I don't know if you've dealt with the exponential number. Some people call it Euler's number, but the exponential number E is an important number. It's used a great deal in mathematics. It is of direct relevance when we come to the Black Scholes Option Model. So we will be exploring the empirical number. Nextly, once we've looked at the empirical number, we'll then see how that is used for continuous discounting and compounding. We're used to the idea, when we're doing business valuation, we're used to the idea of end of period discounting, where we take the end of the year, or we take the 6 months and we take the average of the 6-month period. What we're looking at is continuous discounting, and that requires the use of the exponential number. We'll then be looking at the nature of volatility, just explaining what volatility is, how it's computed, and how we should think of it. And then the way that volatility impacts on the returns within the Black Scholes model. We'll then look at the risk-free rate in the model and the concept of dynamic hedging. And it's the concept of dynamic hedging that led to the 3 authors of the Black Scholes model obtaining the Nobel Prize. Rather than the production of the model, it was a central part of the model, which was the concept of dynamic hedging, which led to the Nobel Prize. And related to that, one of the things is to say why there is no equity risk premium, why the capital asset pricing model does not appear as part of the Black Scholes model. Now, continuing with the structure of the sessions, we'll then look at the n function. You'll have seen the formulae had ND1 and ND2. The n function is a normal distribution function, and it's easily obtained either from tables or from more commonly from Excel. We'll look at that. We'll then look at the derivation of ND2, where it comes from, an overview of ND1, because that is rather more complex mathematically, and then we'll consider the application to private companies, which I've already touched upon.